The cost of home ownership. It's a topic we've covered extensively here at ABC 10. It's more than just the down payment. Homeowners have to pay for everything from insurance to a mortgage, and those rates are high right now. And in this Dollars and Cents episode, I have everything that you need to know. Hello, I'm Laura Painter. It's a headline you've seen. Home insurance companies like AIG and Allstate leaving California and pulling out of the new homeowners insurance market. It's leaving many homeowners and potential homeowners with questions and concerns, and rightfully so. Earlier this year, I talked with some experts to explain what's going on. Take a look.
This problem is a big problem. It's affecting a lot of people.
Home insurance availability, affordability, and quality are shrinking. AIG, Allstate, and State Farm have recently pulled out of the new homeowners insurance market in California.
People really feel like they've been kicked to the curb by these insurance companies that have always been happy to take their money.
A viewer in Auburn wrote to me her insurance premium costs have gone up from just under $2,500 to more than $10,000. She goes on to explain she's reached out directly to insurance companies and brokers for quotes, but she says she can only afford the state's fire-only insurance called the Fair Plan for just under $7,000. Additional insurance, called Difference in Conditions insurance, helps fill in the gaps of the Fair Plan. It would cost her nearly another $1,800 for a total of $8,737. Not a far cry from her initial renewal of more than $10,000.
We have seen quite a few large wildfires in the last 6 years, and a lot of money has gone out to pay for those repairs, losses.
Inflation, the increased cost to rebuild, and contractor shortages are to blame for higher insurance costs too, and experts say that has spooked insurance companies.
I think the thing that's driving this crazy market that we have is a lot of it is just insurers getting too much information from these prediction companies. And it's just scaring them out of wanting to take risk, which is what we rely on them to do.
But not having coverage isn't worth the risk. Nonprofit consumer advocacy group United Policyholders just updated its tips list to reflect the increasing challenges homeowners are facing. They include carry the highest deductible you feel comfortable with, bundle your home and car insurance, get rid of non-essential coverages, and don't be afraid to ask to reduce coverage of what you don't need. Be sure to really shop around and find a good agent.
It's important to try to find savings, but understand the old penny wise, pound foolish rule, which is you may put yourself in a position where you can't afford to rebuild because the coverage you have isn't good enough.
Earlier this year, natural disasters were on the minds of many people as we saw record rain and flooding in our region. That's after years of devastating wildfires. Many people are now wondering what they can do ahead of time to protect their family, home, and property. I talked with an insurance expert about what you can do right now.
Not understanding coverages is a big thing that I see. Some people assume they're fully covered.
Realizing you're not going to get the help you expect is not the place you want to be after a disaster strikes. Omar Ochoa's law firm specializes in insurance claims, and he says you should check your insurance coverage now and catalog your belongings.
Jewelry, electronics, furniture, clothes, anything that you could lose in a disaster situation.
Keeping a good log and taking photos and even saving receipts will help you maximize your recovery.
That includes knowing how old your roof is, for example, because the age of the roof could affect how much you recover.
One reason to have insurance in the first place is to replace things like clothes, furniture, or electronics that get damaged. You might be tempted to start cleaning up as soon as it's safe to return home, but Omar says, wait. Make sure your agent sees your damaged belongings first.
Don't throw those in the trash prior to an insurance adjuster looking at them. Keep them somewhere where they can be physically inspected so that you can get coverage for those items.
Take a close look at your policy now so you're not surprised by what might not be covered. Find out if you have what's called a replacement cost value policy or an actual cost value policy. A replacement cost value policy covers 100% of the costs minus your deductible for the repairs. In an actual cost value policy, you're going to have a deduction for the age of your property.
So, for example, if you have a roof that's 20 years old, it's a 30-year roof, it costs $10,000 to replace it, your insurance is only going to cover 1/3 of that.
It's easy to get carried away with spending, especially if you are a new homeowner or if you just like to shop. I have some good news. There's a free local program helping people of all ages, including families with students, get their finances under control.
We have a lot of entrepreneurs in our family.
For Antelope native Sophia O'Neill Roberts, financial literacy started at home.
My sister right now, she owns a juicing business that she runs in Long Beach. And my mom, she's a chef.
Sophia is getting her master's degree in real estate development and design at UC Berkeley. She admits being a student isn't cheap.
I felt like my money wasn't really going to my savings and I couldn't really track it.
That's why she signed up for free financial coaching through the Sacramento Financial Empowerment Program.
It's essentially a program that's offering as a free service to local Sacramento residents free one-on-one personalized financial coaching.
Coaches work with clients like Sophia to help them reach their financial goals, such as improving credit, reducing debt, building savings, or connecting with safe banking services.
Success is different to every client because every client has different goals and dreams for themselves and their family. So the coaches work really closely with each client to determine what their goals are and how they can help them reach those particular goals.
For Sophia, her goal was to watch her spending.
I think I did a lot of online shopping because it's online, it's easy, it's accessible. I really liked having the feeling of getting like a package each week.
When we're talking about money, we're never just talking about money. We're never just talking about dollars and cents. Our finances are connected to our survival and our thriving. We're not therapists, but we know that these emotions come up.
Financial experts like Maureen help Sophia and other clients stay responsible and accountable for their money situation through regular check-ins.
Debt is usually one of the most common things that folks come to us with. There is no money problem that is too big to overcome.
Since she started the program, Sophia has opened up a high-interest savings account, reined in her shopping habits, and understands the cost of higher education.
I think it's a way of holding myself accountable by kind of working with them just because I know that they want the best for me and I signed up to do this, so I might as well do the work.
Just before the summer kicked off, new government changes went into effect in regards to the mortgage fee structure. This was a big concern to many of you who wrote in, worried about claims saying a high credit score won't get you as much funds as it used to. I wanted to ease your mind, so I talked with experts about this, and here's what they had to say.
Buying a home and owning a home is the American dream.
New changes are now in effect to help make that dream a reality for more people.
And this is the most significant financial transaction you'll make in your entire life, and if you're a first-time home buyer especially, it can be overwhelming.
And expensive. So the federal government put into place a new mortgage fee structure this spring. It's meant to help lower the fee gap between borrowers with high FICO credit scores and those with lower ones by reducing their closing costs.
That would give them more room to have more buying power and be able to purchase.
Here's what happened. The Federal Housing Finance Agency recently updated a pricing structure that applies to about 80% of the mortgage market, loans originated by Fannie Mae or Freddie Mac.
The changes are really to what's called loan level price adjustments, and that's how Fannie Mae and Freddie Mac, they impose risk-based pricing, and these are hits to pricing based on your credit score, based on your loan to value, based on your potential overall risk to them as a borrower.
And despite what you see online, this isn't necessarily a new fee. Lenders have had to deal with the changes months before the official rollout announced May 1st. Plus, the impact to creditworthy borrowers is probably less significant than you've been led to believe.
There's a misconception out there that now people with lower FICO scores can get a better rate now based on this than someone with a higher FICO score. And that is not the case.
Do you think that these changes could have a true impact of that goal that they're trying to achieve?
Yeah, I mean, I would say that in certain instances, a potential first-time home buyer could lower their monthly payment based on these changes by maybe $50, $60, $75, depending on their loan amount, and that could help them qualify for a loan that they otherwise wouldn't qualify for.
But these fees levied by the FHFA have caused uproar among some mortgage professionals. The Mortgage Bankers Association came out against the overhaul, saying it, quote, is unworkable and should be removed. The backlash to the overhaul spurred the agency, which levies the fees, to issue a recent statement calling such concerns, quote, a fundamental misunderstanding.
Good credit to keep having good credit, and then the people who have not so great credit they're giving them an opportunity to purchase, but are they able to handle the mortgage on top of all the bills that come along with it?
These fees are important for you to know because a down payment isn't the only thing you're bringing to the table when buying a home. Closing costs are expenses you pay to your lender in exchange for loan services. Closing costs usually make up 3 to 6% of the loan amount, meaning if you take out a mortgage worth $200,000, you can expect your closing cost to be about $6,000 to $12,000.
It's an important factor to purchase a home, and I believe every family should have one because it is their foundation for their family and to grow up, to have memories.
Don't let this discourage you from buying a home. Educate yourself, get a good loan officer that can help you learn, the nuances of this, because this is very nuanced.
Buying a home can be challenging, but now inflation and high interest rates are adding to the already high cost of home ownership. I talked with an expert about Sacramento's real estate market to find out what the future holds.
But if you're a renter, it's tough to find a property.
There isn't a ton of supply in the Sacramento housing market at the moment. Inflation and high interest rates are making the cost of borrowing money more expensive, so more people are staying put.
People already have a low mortgage interest rate. They don't want to move.
That means fewer homes on the market, and that's driving up demand for the people who want a home, meaning prices can go up.
And now that the weather's turning and people are starting to think a little bit more about, potentially moving, we're seeing some demand where prices are pretty, they're not white hot like they were in 2021, but they're not bad.
Take a look at this graph. There's a lot of information here, but if you zero in on the far right side, you'll see prices in Sacramento have risen this spring after a months-long decline for most of last year. The lack of supply has led to some strength coming out of the winter. If you want to rent a home, listen up. This impacts you too.
Landlords have been able to get away with increasing rents, which has been an attractive thing from the standpoint of buying and selling investment real estate as well.
On the flip side, if you're retiring or downsizing, keeping your home as a rental property might be something you want to think about.
But I'm not going to be so inclined to want to let that home go and that attractive mortgage rate go. Perhaps I hold on to that home, turn it into an investment property, again, because primarily that interest rate on the mortgage on that home is very attractive as compared to 6.5% today.
Thank you for watching this Dollars and Cents episode on home insurance and housing. If you want to watch more features just like this one, check out our ABC 10 Plus app. There you'll find the latest newscasts and headlines. Stay up to date on the weather and see all the great work and stories that we tell right here at ABC 10. Thank you for watching. Take care.